Fala pessoal, sejam todos muito bem-vindos para mais um Global Pickers, para lá de especial, porque hoje teremos nesse novo formato, pela primeira vez, um programa realmente global. Então nós vamos falar sobre o que está acontecendo no mundo com uma visão de um grande gestor, de uma gestora norte-americana, né, que eu explicarei um pouquinho melhor como vai funcionar logo após a nossa abertura. Muito legal, pessoal. O nosso convidado de hoje já está na tela, é John Boselli, Portfólio Manager, que basicamente significa gestor de ações globais da Wellington Management. E a Wellington é uma das principais gestoras de ativos independentes do mundo, fundada lá em 1928, com presença atualmente nos principais centros financeiros internacionais, asiáticos, enfim, fornecendo aos clientes conhecimento local com uma experiência global. Ao meu lado, nós temos Fernando Ferreira, que vocês já conhecem há muito tempo, Head do Research e estrategista-chefe da XP. Muito boa noite, Ferreira.
Boa noite, Henrique. Obrigado pelo convite. Uma honra estar aqui junto com o John para a gente bater esse papo hoje.
Legal. E agora nós vamos mudar para inglês, para uma melhor comunicação, então, com nossos convidados. Fique aqui, né, acompanhando a nossa live agora, lendo. Se você não compreende, não tem problema, a legenda está aqui embaixo. Hello, John. Thank you for accepting our invitation. Be very welcome.
Thank you, Henrique.
So, Ferreira, would you like to start with the first question here?
Sure, absolutely. So, John, we've seen a lot of volatility this year, right? I mean, we've seen the equity indices falling to close to bear market territory, right? Some sectors are even in deep bear market territory if you consider how much they fell, right, year to date. And we've seen a lot of issues, right, being geopolitics with war in Ukraine, the zero COVID policies in China, all of the tighter monetary policy, right, higher interest rates in the world. I mean, how do you assess this scenario for 2022 and beyond? Have you changed your thinking or the way you approach, right, your stock allocations and how you think about sectors due to all of this volatility?
Yes, absolutely. We react to the environment that we see ourselves. So, coming into the year, we saw that it was a combination of a conflict in the Ukraine. We anticipated surging inflation and higher interest rates, leading to tighter monetary policy, and that created this difficult investment landscape. And our investment philosophy really is to take the highest quality, the highest growth businesses that return capital to shareholders with great upside, valuation upside, and fundamentals. Those are the types of stocks that we look to invest in. In this environment where inflation was rising and interest rates were moving higher, what we did is we put an emphasis on valuation and quality. And so we essentially sold all of the expensive stocks out of the portfolio, and we repositioned more towards the financial sector. Given the higher interest rates would lead to higher net interest margins and positive earnings revisions. And so that part has been completed. It's interesting as we look forward, we believe that with China reopening, manufacturing opening, the supply lines freeing, the market's already tightened ahead of the Fed, and you're starting to see employment levels decline slightly, just the start of it. And so it's our belief that inflation is under control, more under control today than it was, say, 3 to 6 months ago. We think inflation will peak in the third or fourth quarter, and we think the Fed will have to raise interest rates fewer times than the market anticipates. And so we have slowly but surely refocused the portfolio over the last, say, 3 to 4 weeks. We still remain bearish on the consumer, just given the real wage growth is negative in many countries, but especially in the Americas and developed markets. And really our overweights include the technology, the healthcare, and the financial services sectors. Those are where we find great value and benefit from this inflationary environment.
John, you just talked about inflation and increasing rates. So I would like to ask you something about this increasingly worried about profitability of U.S. and global recession. how much do you worry about it? And do you think the market has already discounted that into asset price?
So we think it depends on the sector itself. And so, if you look at the consumer sector, it's very difficult for the consumer sector, whether it's consumer staples or consumer discretionary, be it retail. It's very difficult for those companies to pass inflation through. For more of the software businesses, defense companies, financial and services businesses, they do have sort of automatic price escalators in some of the contracts in which they sell their product. And so it's less of an issue. Okay, so it's a matter of finding those businesses, those sectors, those industries in which there's a competitive advantage, some sort of barrier to entry in which pricing doesn't fall to the lowest common denominator. And so you'll notice that we are very underweight both consumer sectors, and we're overweight tech and healthcare and financials.
And you talked about being bearish on the consumer and being underweight, right, on those sectors. Do you see a probability of a recession in the near term? I mean, the market seemed to be really worried about a recession risks, right, in recent months.
Yeah, so we use something called, it's slightly different than what the market focuses on in recession. Recession is just definitional. It's 2 quarters of negative growth. So I don't, that doesn't add too much value. But we use something called the Global Cycle Index, and it has 7 indicators that are very effective at forecasting global economic growth. Okay, and so in the fourth quarter, December, November of last year, we anticipated the Global Cycle Index to begin falling, in part due to inflation, but also the Fed tightening and these other issues. And so we anticipated that. And when we anticipate the global economic cycle declining, at that point we go over really high quality businesses that return capital to shareholders that are undervalued. So those will shift the portfolio based upon that global cycle index. Our global cycle index today shows a bottoming in Q3 and perhaps an improvement in Q4. So what we've done in the last many weeks is shifted the focus and really be more balanced going forward. So instead of being high quality dividend yielding, we still have those characteristics, but we want to level the playing field and really focus on all 4 factors that are driving stock prices.
And one of the sectors that has been beaten up the most is the tech sector, right? Which has been a huge winner over the last decade or so, right? But when we see tech stocks being down as much as they did, a lot of people started to compare and contrast with the .com times and the huge declines we saw in the 2000s, early 2000s, right? But our view here is that the big techs nowadays are completely different, right? They generate a ton of cash, they continue to grow, and now they're trading at pretty attractive multiples, right? Even on earnings or cash flow. Do you agree with this view? Do you see value in big tech? I mean, how do you think about the broad tech space, right? Considering more than just information technology, but the tech plus, if you will.
Sure. So it's interesting. I was a global industry analyst back in 98, 99, and 2000. And so what the typical company back then was more hardware oriented, serving sort of telecom infrastructure, internet infrastructure, and those businesses were not self-sustaining. And there was a lot of M&A, there was a lot of financial debt, et cetera. Today, it's totally different. Today, the most successful technology companies are software and applications driven. And they've got much less capital and infrastructure requirements today than ever. In fact, cloud services, whether it's offered by AWS, Amazon Web Service, or Microsoft Azure or Google Cloud, they're providing these web services to startups and mature companies, which is a lot more capital efficient. And these businesses generate margins and cash flow pretty quickly. So that the entire technology environment has changed, and today is a lot more healthy, a lot more sustainable. However, some of those businesses, such as enterprise software, one has to be careful because of the margin structure. And as interest rates rose in the first half of this year, higher interest rates typically punishes higher multiple stocks, and especially companies that don't generate positive free cash flow margin. So we were very careful to avoid those types of businesses. I would also say scale is incredibly important today because most businesses are global, right? And so having a global scale allows the biggest companies to invest globally across a platform to generate enormous returns on capital and free cash flow. So, we've tended to own the larger cap technology stocks over the last 3 to 5 years. And that's because success begets success in the technology business. Once, Apple has their handset and their market share across the world, they load that with services and software and other sort of more predictable, more durable revenue streams that have extraordinarily high margins. And we tend to like those businesses. But in terms of valuation today, most technology companies are more expensive than the market today, just to be fair. Poorly positioned companies, obviously trading at a discount. We have cut back on our technology holdings over the last 12 months as stocks reached target prices that we thought were fair. But really what we're focused on are those companies that still have good valuation upside, good returns, good organic growth. These companies tend to sell on a contractual basis year after year with price escalators. So these, large cap, global, multinational software application businesses tend to be very good businesses for a long time.
John, I think the market is very focused in commodities right now, of course, all the environment globally speaking. So I would like to know what's your view on commodities, and are we due for a longer cycle, or do you expect prices to correct once the global economy starts to slow down?
Sure. So it's interesting because I studied petroleum engineering at university. And after graduating, I worked in Manaus in the energy business for a number of years. And so I know a lot about the exploration business, the refining, and the transportation business. I think what's happening today is there is ample supply of energy around the world. Ample. The issue that we have is the refining capacity and the transportation infrastructure, given what's happening in the Ukraine and other markets around the world. And those bottlenecks are causing backups in the deliveries of gas and crude oil. So at $120 oil price, energy companies are generating substantial excess cash flows today. Historically, excess cash returns in commodity-oriented businesses have not lasted a long period of time. So that's just historical context. Today, there is a slight difference in that most management teams of energy companies, they're no longer paid on production growth, which was the old way to incentivize management teams. Today, most energy management teams are incentivized on cash generation first, producing cash, and second, returning that cash to shareholders. So that has in some ways controlled the volume or supply of oil. But nonetheless, if we believe energy gets too high, that will impact demand eventually. So to be honest, forecasting commodity prices is not part of my investment philosophy or process. I don't really have a strong conviction on oil prices, iron ore, coal, etc. Globally, most commodities grow demand at 0 to 1%. And keep in mind that the types of businesses that tend to outperform consistently are growing organic revenues 8 to 10%. And so, again, those are the types of businesses that tend to generate positive alpha, and we tend to own in the portfolios. We do own some energy and natural resources businesses, but it's just, if you look historically, if you back test which types of stocks outperform, it's very difficult for companies growing units sort of 1, 2, 3% to generate positive alpha over a longer time period. And so we don't forecast energy prices or raw material or commodity prices, and so we tend to be very underweight those sectors over time.
Got it. And John, another sector that is pretty relevant on a global perspective, but not as relevant here in Brazil, that we don't talk much about it, is the healthcare and the pharma sector. But in this current environment, right, where everyone is positioning a little bit more defensive, how do you see that sector within this framework and in the current scenario, and within the broad healthcare space, which subsectors do you see as more interesting?
Sure. So we believe some of the most attractive investment opportunities in the marketplace today are pharmaceutical and healthcare services, both of those sectors within healthcare itself. So pharmaceutical companies benefit from an aging population globally and new disease categories that are being discovered all the time. And so to the extent that, those disease categories are approached and researched by a pharmaceutical company, and they have competitive advantages in discovering and processing research and development, those disease categories, they tend to be more successful. Okay, so we're looking for very specific pharmaceutical companies attacking a specific disease state. One of the benefits that we have at Wellington is we have one of the best healthcare teams in the world. And so there's about 12 investors on that team, and they cover every healthcare stock above 3 billion market cap that you can imagine in all the markets of the world. So it's a competitive advantage. The typical pharma company that's most attractive to us, it's typically companies that have gone through a patent expiration period, and so they've had negative revenue growth for maybe 3 to 5 years. As a result of that, they've had to cut costs, but yet they have a disease state that they're on the near-term discovery of that disease state and offering a pharmaceutical product to the market, whether it be cancer, diabetes, obesity, whatever it might be. Pharmaceutical companies that have had negative sort of revenue declines for a period of time, and then there's an inflection in which the revenue growth starts to accelerate. Those types of businesses tend to be the best pharmaceutical companies in the market. We tend to avoid biotech because they don't generate positive free cash flow. And so we want cash. We want cash. We want that cash distributed back to shareholders. In terms of healthcare service companies, also very good opportunities for these businesses. We've owned these companies for many, many, many years. They provide a service to patients or the pharmaceutical industry. So, for example, companies that provide clinical research services to the pharmaceutical or biotech companies, they outsource it to these clinical service companies. Very predictable lab testing, sort of research, R&D, data, and regulatory advice that they give to pharmaceutical companies. Long-term 3 to 5 year contracts, price escalators, very predictable revenue and free cash flow streams. Also, managed care companies. These are businesses that coordinate consumer healthcare services with the general population and administrators at hospitals or medical centers or even doctors themselves. So they're the middleman in the healthcare food chain, so to speak. Healthcare services companies, they tend to have very predictable businesses. The margins are a little bit tighter than pharmaceutical companies, but they're very predictable revenue streams, very little capital intensity, and they generate a lot of cash flows. And so we're very much attracted to both healthcare services and pharmaceutical companies around the world.
John, another sector that was supposed to perform well on the current environment of higher rates is financials. You just spoke a little bit at the beginning, but I would like to know what's your view on that. But what we saw recently is a strong correction on the big banks in the US. Yes. And so why is that happening? And should the bank stock respond more to the interest rate scenario, or it's all about the economy?
So I believe that there's a few things to consider when investing in banks. And first is the national government regulations. Every country in the world regulates their banks in a different way. And some banks allow higher returns on assets because banking is such an important part of their capital allocation within the country. And some countries do not allow high returns on assets. And so regulations and competition are incredibly relevant across the world. So U.S. banks they've gone through a period, I would say about a 10-year period, where they've been disintermediated by new lending companies in fintech, financial technology companies that offer more value-added solutions than the banks can offer themselves. It's interesting, on the lending side, private capital investments have taken a larger share of lending away from the banks. Also, with private equity and venture capital booming, there's a lot of capital going into what we call fintech, this financial technology industry. And they've been competing with the larger, sort of slower moving banks across the world, but even in the United States. And these dynamics, we've been leaning towards private capital lending businesses. So they're not banks per se. It's mostly private capital lending. And secondly, fintech companies, which have enormous addressable markets that the banks don't have the competition. They don't have the technology to compete in those markets. I would say another recent issue with at least the U.S. banks is that there are increased capital requirements at the banking level. Banks are required to maintain a certain buffer above these capital levels, or they face severe consequences, including fines, and also dividends could be withdrawn, and management compensation is affected. And so what these management teams have done is they've built in additional buffers on top of these capital requirements over the last few years to be more conservative. And as a result, they've lowered the amount of capital returned to shareholders over the last 6 months. And we expect that to continue for another period of time. But that's why we think that the U.S. banks have underperformed more recently.
Interesting, especially the views that fintech can do well, right? Because what we've seen in Brazil is that investors have turned really bearish on fintech because we've seen a massive increase in interest rates, right? So people are wondering if they can thrive on a higher rate scenario, right? Of course, Brazil has pretty high interest rates, but it's definitely not a consensus view at the moment here with Brazilian investors.
Yeah, I think the difference is in the U.S. there's something like 5,000 banks across the country, very distributed platforms, and they just don't have the market power that the Brazilian banks have. And so it's the private capital markets in the U.S. are more developed than you might see in Brazil, and so that it's very natural or normal for an enterprise to borrow money from a private lender. Without having all that public market disclosure requirements, and usually the interest rates are favorable. So it's just a different dynamic in Brazil versus the United States, and fintech and these private lenders have really grown their market share dramatically.
Right. And John, another sector that benefited a lot, right, from the pandemic and the low interest rate scenario was housing, right? We saw housing prices going up a lot, not only in the U.S. but pretty much globally, right? Do you think there's a risk on prices in housing here, and if that happens, right, can we see an impact on other sectors like the financials, like the banks, as we just mentioned?
Sure. So the housing cycle boom really has been caused by lower mortgage rates and consumer confidence. Those are the two variables that will affect housing prices up and down in every cycle. So, given that mortgage rates are tied to inflation and the Fed tightening, we've seen in the U.S. mortgage rates go up about 150 to 200 basis points, depending on the region and the classification of the mortgage itself. And what that leads to is housing costs being a higher percentage of disposable income across the U.S. and many markets, European markets as well. What's happened more recently, and I'm talking in the last number of weeks, is you've started to see for the first time housing inventory starting to rise, and you've seen a slowdown in the housing activities. And so that has really affected the real estate market. And that's a very common cycle across housing across the world. So I think what's different about this cycle versus prior cycle is there's really not a lot of excess inventory. So if you remember back to 2008, 2009, the global financial crisis, less capital was allocated to the housing market. And so the home builders across the country, they've built fewer homes. So the normal number of homes built each year is about 1.5 million across the US. There's a similar amount across Europe, but what the market was producing each year was about 1 million units. So there was a deficit for the last decade. And so that has really controlled the amount of inventory in the marketplace. So it's been interesting. So you've got higher mortgage rates affecting consumer confidence, disposable income spending, and the value of real estate, but there's not a lot of excess inventory in the markets yet. And so housing prices have really not come off that much. If inflation continues to exceed wage growth for more than, say, 6 to 9 months, consumer confidence will start to go, unemployment will start to rise, and that will put a squeeze on housing. Mortgage delinquencies will rise in that kind of environment, and impairment charges will come on the banks. And so we don't own banks. We think there's a bit of risk on near-term write-offs in this situation, but it's still too early to know entirely how the banking sector will react to this slowdown.
Right, and probably a little bit different as well from the 2008 crisis.
Exactly. Yeah.
That's very interesting. And John, going forward here, the last earnings season showed that in general, most companies haven't been able to pass through inflation, and the EPS of the S&P 500 continued to be revised upwards. However, we were a few notable exceptions, especially on the retail sector, like Walmart, Target. We are seeing these companies cutting their estimates. So what you're seeing in the sector is that maybe not everybody are being able to pass this inflation through. So do you think that this is a theme to monitor closely, and how it might impact the profitability and margins going forward?
Yes, no. Understanding which sectors and companies can pass through inflation is critical to investing, not only today, but always. And, being underweight consumer is driven in part to this inability to pass through inflation. It's not all retail companies, not all consumer companies, but there's a substantial number of businesses in the consumer sector that can't pass through that full amount. And the reason is pretty simple. When your wages are going up 5 or 6% and the cost of inflation is going up 8, 9, or 10%, the real wage growth is negative. And so what consumers do is they trade down. Especially the low and lower middle income consumer. And so you've seen companies trade down. That happened at Target and Walmart, as you suggested. And it impacts their gross margins, it impacts their operating margins, and effectively the earnings revisions turn negative. So we spend an enormous amount of time analyzing industry and sector positioning and competitive dynamics. Today, a very high percentage of the companies in the portfolios that we manage either sell on a contractual basis or have price escalators. And whether it's in healthcare services or software and services, or even some of the financial service businesses that we cover, one easy example to understand is insurance distributors. They charge a fee as a percentage of revenues. So actually, they like inflation, because when you've got inflation, typically enterprises and consumers, they have to inflate a higher value. They have to insure a higher value. And when those insurance rates go up to cover that higher amount, the percent charge for their revenues goes up as well. So, that's just a very simple example of you want to, in inflationary times, you want to own companies that can pass through that inflation and benefit on a revenues and earnings basis.
Right. And in that sense of being able to pass through and generate cash, right? You talked a lot about this ability to generate cash flow. And what we see is that a lot of individual investors, they focus a lot on dividends, right, and dividend yield on their stock selection process. So sectors like REITs, right, are very popular with amongst the individual investors. So just wanted to understand, in your view, how relevant are dividends, and if you have any suggestions to the investors that are listening to us, how can they think about dividends, and if that is really the way of selecting stocks or not?
Yeah, so I think dividends are extraordinarily important. I would add to dividends share repurchases. So whether a company has a 3% dividend yield or buys back the net shares each year of 3 to 4%, depending on the valuation of the underlying security, I'm kind of indifferent whether they buy stock back or they pay a dividend. But one of the strongest predictors of stock prices over longer periods of time is a combination of a dividend yield, a good dividend yield, and net share repurchase. So I think it's incredibly important. However, one must look at the underlying free cash flow generation of each of the businesses they generate in order to verify that the dividend payout or the share repurchase amount is fully covered by the free cash flows generated in the business. To borrow money to pay a dividend or to buy stock back is substantially inferior to a business that generates excess free cash flow, invests that cash flow into growing the business at a high organic rate, and have more cash left over to pay a dividend or buy back stock. So just going on dividend yield alone, I don't think it's sufficient. I think one must look at the underlying levels of cash flow generated today and over the next 5 years to ensure that payout ratio will be high going forward.
All right, John. Just to finish here, we have a custom here in Stock Pickers in general that always we ask for our guests to suggest a book for our audience, and it could be regarding the market, economics, or any book that has personally inspired you. So would you like to mention any book here?
Wow, I wasn't prepared for this question. So yeah, I mean, there's a book on strengths awareness, and it talks about being self-aware as an investor. Okay, and the reason being self-aware as an investor is you will understand your tendencies in the marketplace, and whether those tendencies are action-oriented or optimism or pessimism or judgment calls. Having a balanced view on markets and being self-aware is enormously important in volatile times. So I would say a strengths assessments book is really important for investors going forward.
Nice. So John, we are ending here our live stream. Actually, it was not live, just the stream. So it was an honor to have you here. Thank you so much again for accepting our invitation, and you are always able to come here when you want. It was a big pleasure for us. Thank you very much.
Thank you, Henrique. It was a pleasure to speak with both of you. It was really fun. I enjoyed it.
Nice.
Thanks, John.
Thank you, Fernando. Have a great day. I hope so.
You too. Bye.
Bye-bye.